So, welcome back to another episode of the Financial Bites podcast. I am your host and social media CPA, Chris Passmore. Today, we are going to discuss investing in a turbulent time. We've got inflation, we've got what was a bear market, now we're not a bear market. So, I'd like to welcome our guest, Joe Seetoo, to the podcast. So, Joe, welcome.
Hey, Chris, great to be with you. Thanks for having me on, and I'm looking forward to our discussion.
So, Joe, you're a partner, senior vice president at Morton Wealth, an investment company based here in California. And one tagline I read on your website that I absolutely loved, it says, "Wealth must be managed personally if it is to truly enhance your life." So please tell us a little bit more about you and the great team at Morton.
Yeah, well, we been a partner here at Morton. Morton was founded, in the '80s. So we're an independent fiduciary advisory firm. We focus really heavily on financial planning and then discretionary asset management for our clients. So, I think that you brought up this idea of personal wealth. The strategy being tailored directly to personally for the client. And I think where we go with this is so oftentimes, right, and you even teed it up around there being a bear market, everyone always defaults to the investments right away around like, hey, what should I do with my money? How can I get it to grow? And while those are very critical questions, what I think we really want to try to get our clients to understand is that the investment piece is strategy and execution. It's sort of a means to an end. And I think all too often, especially we'll talk more about it in the podcast here, like I think oftentimes one of the fundamental mistakes human beings make is we think that the investments are sort of an end in and of itself. And we forget that like there's a real purpose around why we're investing the way we do. And it's for it's really for hopefully an outcome in our life that we want to manifest something, right? We want to be able to put our kids to college. We want to know we can retire at a certain date and time. We want to be able to give to that charity in our community that means so much because it's doing the things that we value in our own lives, right? And so trying to really make sure that we craft a plan, what I call it, their financial roadmap or a life plan that's important for Chris Passmore, for Joe C, whoever we're working with, but that's in alignment with the investment strategy is really one of the missions we have at Morton. And how we do that, that's how we ultimately make better investors.
So what you're saying is almost that people focus too much on the tactics, the investments. This is a vehicle to get somewhere.
Yeah.
And really almost lose sight of, well, where are we going?
Yeah, well, yeah. Like, let me give you a perfect example, okay? You and I could both want to take a trip to New York, right? Now, your reason for going there and my reason for going there could be very different, right? You could be going because you lost, hypothetically, your mother or grandmother. I'm going because I'm going on vacation. Now, while our destination is theoretically the same, our reason for going is very different. So that is going to shape our modes of travel, how we get there, right? You're probably going to be less sensitive to the cost of a plane ticket, to flying in the middle of the night, to making certain sacrifices because your reason for getting there is you want to get there as quickly as possible, right? There's a very emotional reason for you going, where if I'm going because of vacation, what? Airline airfares right now are through the roof. We know that, when we go to the airport, the lines are, right? Flights are getting canceled, right? So I might say, I'm going to pump my trip to New York until the summer when I think that, inflation's coming down. It's probably nicer in the summer. The weather's going to be different. And so my point is that until you dig down into the reasons why, and also sort of how people want to get there, wherever there is, you can't, it's just a very different journey, even though the end goals could be the same.
And so it sounds like yourself and the team at Morton have that in-depth discussion with your clients of, let's worry about the investment second. Tell me what you want to accomplish in your life. Tell me what's important to you.
Yeah.
Tell me the things you want to have on your bucket list, and then we'll design a plan to help you achieve those things?
Yeah, absolutely. I think that's a great analogy, right? Around, so I come back to, goals are the tangible things. Like we always talk about like goal-based planning, or you hear that in this industry. You can even hear it in accounting work like that you're doing. So like, what are the things you want to see that are out there that you can measure that are tangible? And so those are our goals. But if you take that a layer deeper, sort of underneath the roots of the tree, or the roots of who we are, is our values are the things that shape the reasons why those goals are important.
Hmm.
And if we can create alignment between the goals that we have with who we are and the strategy, whatever that strategy is, the investments, the tax planning, the estate planning, right, the risk management through insurance, then your probability of success and people being fulfilled and sticking with a plan, by the way, that in a market like 2022 was very challenging, but isn't hopefully the end of the world. They're likely to stick with that plan much longer and sort of through thick and thin, and they're going to have faith in it because it's in alignment with who they are and the things they really want to see in their life.
So talking about that general philosophy of yourself and the team at Morton, what's your typical client? Who do you normally work with?
Yeah,
And what do they look like on paper?
Yeah, so from a high level, we're dealing with relatively affluent families, sort of your typical high net worth individual, 2 to 20 million of investable assets. We have a number of maybe Fortune 500 executives as well whose net worths exceed that. But that's where we tend to find our sweet spot in terms of there's a real sort of gap, I think, in service, both from a client. We have a great client service here in terms of Morton, in terms of our advisory team, the team behind them, the operations team, on providing that high-end concierge service, white glove service, coupled with in-depth financial planning. We have something like 15 CFPs on staff as well. And then part of our investment strategy is really in bringing in what we call niche alternative type investments that are really much more institutional in nature to bear to us as part of the portfolio investment philosophy. You generally don't. You're seeing a little bit more of it now, but for years that was a really, and it has been a huge competitive advantage of ours. So being able to sort of bring all this together and serve that market has been why our clients tend to fall in that category.
Okay. Well, yeah, and there's a definite need. And so let's just dive right in. And I was looking up before we started the podcast some statistics over the past 6 to 12 months. And looking at the S&P, at the end of 2022, we were down 9 or 10%. And then you've got this surge in January, and then it dipped down again. The NASDAQ was down almost 20% going into the end of last year with a similar surge. Where do you think we're going? Where's this bus going, Joe? Are we riding the wave again this year, or is it hang on for hills and valleys this year?
So I just want to make sure on the same page. The S&P was down about 19% last year for the calendar year, and the NASDAQ was down almost 30. Mm-hmm. So we were in a traditional bear market. Look, I don't know if it was Yogi Berra said predictions are tough to make, especially about the future. What I will say is this, right? And I want to make sure I give you an answer to the question. The short term, it's actually easier, right, to make projections over a longer term because you kind of get reversion to the mean. Mm-hmm. Year-to-year fluctuations in the stock market are notoriously challenging, right? Because if you just look at history, right, you see years where you're up 50% and years where you're down 50%. And that is just a wide range of variability. I think it really comes down to the question I think you're asking is story 2023, I think is going to come down a little to, you're seeing a big push and pull between the bond market on the one hand, right, that's actually forecasting rates drift lower, that inflation, which seems to be rolling over, will likely that we are going to go into that direction. And the stock market, with a little bit of a bump that we've seen in the first part of January, seems to be saying, okay, we're not headed for a very deep recession just yet. But on the other hand, you have the Fed talking very, very tough about them partially, that they're going to continue to have to ratchet up interest rates. They're going to do whatever they need to combat inflation. Part of that, I think, is posturing because they were very late to tightening this round. They were way behind the 8 ball. So, if I had to guess based on sort of what we're seeing, based on just some of the data we're looking at, the underlying economy, while certainly things are softening, it looks like that we might be able to, engineer some sort of soft landing here. But certainly the jury's still out on it. With that said, I will say we are not, because the markets are down, we tend to be a little bit more conservative on our equity allocation. We're not using this yet as an opportunity to sort of back up the truck and load up on our equity exposure just yet. We think it's probably still a little premature. I'll add on to that, sort of a little bit longer term. I think we're in a regime now of lower growth on a go forward. Definitely more restrictive monetary policy that we've not really seen for a decade. Above average inflation. That again, I've been doing this since the late 90s. We haven't really had these inflationary pressures really since the 70s. So that is definitely a different type of risk and a different kind of environment that we're entering into that I think is likely here to stay for a while. Partially because I think with COVID, what we have seen is this idea of onshoring or nearshoring for some of our critical supply chains, that has become sort of a really strategic initiative for the manufacturing base, for the government, for other sectors of the economy that likely will keep inflationary pressures higher than they were in the 80s and 90s and 2000s. But I think we understand that the cost of that is worthwhile from a long-term sort of strategic position.
So one of the points that you mentioned I'd like to talk about a little bit is you mentioned the term back up a truckload to buy into equities.
Yeah.
Fill me in and what does that mean to the listeners? Do you mean that, going against your natural behavior, buy low because obviously the goal is buy low, sell high, or what were you?
No, yeah, look, I think it's a definition of what's low, right? And I think so low in terms of valuations, I think we would argue that valuations still aren't low. They're not a screaming buy just yet. That we would want to see more capitulation before we actually ramped up, our equity exposure substantially beyond where it is, right? But what on the flip side to that, so I'm sorry, does that maybe answer your question?
Well, yeah, it's funny when prices are going lower in the stock market. Let's say someone looks at their 401k and sees the balance go from, 50,000 to 40,000 to 30,000. It seems counterintuitive or against nature to go, I need to buy more. It's more, I need to get out. And that's what I'm trying to focus on.
Okay. Yeah.
That behavioral response is no, I shouldn't get more, but maybe it's actually the opposite.
No, I think what you're saying there, and so again, this comes back to, I think, some of that planning we talked about earlier, right? Your 401k, you and I are reasonably young. We're in our mid 40s. Hopefully we've got, now we have till we'll be 75 to take money out of our retirement accounts because of the change in the Secure Act. And so, in that case, yeah, I would say staying disciplined, right, to dollar cost averaging, right, monthly into your longer term growth assets, you absolutely want to do, because I don't care what stock prices are today. Do I think they're going to be higher in 10 years, 20 years, 30 years from now? Sure. Right. And I'm more aggressive in my sort of, irrespective of what we just talked about, over our predictions of where equity prices are in the next 12, 24 months. Yeah, I'm going to stay disciplined to that. And I invite the fact that prices are lower, right? Because I am buying on a lower valuation level, all other things being equal. I think my comment earlier was perhaps more for those who are maybe they've sold a business, maybe they're retired, maybe they don't have a lot of extra cash, right? And their asset allocations may be more static.
Yeah. Okay. So then let's just talk about investment methodology this year, because we've got, we've talked about recession, not a recession, political turmoil. With Ukraine, we've got inflation, and the whole climate right now is just wonky. So what's like to share a political or investment philosophy with people for this year? Just, stay the course. Just share us your thoughts here on what might be some good tactics to put into place this year, considering just how crazy the world seems right now.
So again, I think it comes down to one is there's short-term tactics, which I would consider 1 year. I would even consider 3 and 5 year timeframes reasonably short when you're talking about investing. And I think one of the challenges is it's a little like, don't shoot yourself in the foot, don't overreact. One thing I would tell the audience is we live in the information age, right? And we think that's perhaps a good thing. The challenge is that because we are so bombarded with information, not all information that you get is advice. is actionable advice. And so to the extent that you can actually tease out, right, what is just noise and information, especially short-term noise, and what is actionable advice. That's one of the critical things I think we have to do, and why it's important to have advisors, whether it's a wealth advisor, a tax planner, whatever it is, who can give you that sort of independent perspective around what's going on today. They can give you maybe some historical perspective and also maybe some thoughts on sort of where things are going. Because I think we as humans, right, we can allow our emotions to sort of hijack our decision-making process around what feels good in the moment, but that ultimately to the long term is really, really sort of the detriment, right? I mean, let's just go back to 2008 real quick. How bad that felt at the time. I mean, literally, like we thought the banks were going to be nationalized, right? I mean, companies like Ford and Bank of America were talking about, you had Lehman going on. You had all these just this carnage, right? And think about the person who was like possibly going to retire in 2020, 12 years away. So maybe they're in their late 50s, hypothetically, right? If you're thinking maybe you'll retire when you're 70, I'm just picking something and making a number up. But gosh, like, you know what? I got to bail and I got to go to cash. And that probably felt really good in the moment, right? And I'm not saying you need to be 100% stocks, but the point is that the person who did that, they probably didn't buy back in the low of 2009, or maybe not even 2010. And perhaps they sat on the sidelines until 2012, 2013, 2014. Maybe they never got fully invested again. Mm-hmm. And so that's just a classic example of how over time, right, things tend to work themselves out. Now, for us, we don't believe that like stocks aren't the only solution, but that's where the alignment around planning and strategy really come into play. To give you some specifics, though, Chris, around some investment ideas, because that's what I hear the question was a minute ago. Look, I think we still like gold. I mean, gold was essentially flat last year, was down a skosh. I think from a short-term tactical perspective, we like the fact that the dollar, the relative strength of the dollar has been coming back off. The dollar lost something like 7 or 8%. The dollar was particularly strong last year, which is why gold actually didn't do even better. The fact that it was flat last year in an environment where virtually bonds were down 13, 14%, so most stocks were down 20 to 30, and yet gold was flat in an environment where the dollar was strong. And traditionally, when the dollar is strong, gold doesn't do well. In the fourth quarter alone, you saw the dollar kind of come down, gold started to come back up. And so the strength of the dollar in 2023 probably, we think won't be the same as it was in 2022. So that's definitely something we're continuing to make sure that we're allocated to, and we like in the short term. China theoretically reopening. They've actually been making more gold purchases as well. And then on the flip side, something that is a little different that we have not been able to say for a number of years is that, while interest rates going up last year punished existing bondholders in terms of just mark to market, you're actually seeing now where you can pick up some interesting yields on some short-term debt, 2 to 3 years. I'll give you an example of an issue that's it's a publicly traded company. It matures in 2025. Yield to maturity is something like 8.5%. So for a relatively short time frame, for the risk we're taking on, you're actually buying it below par, so there's a chance for upside appreciation, and then a yield that's upper single digit. Those are the kind of trades in the credit strategy and bond world that we're actually able to see. So that's kind of attractive. And then last I would even say some value stocks, right, that have strong balance sheets, that are companies that they're not necessarily price takers, they're the ones that can pass on the inflationary costs to the market, to the consumer. I think those will give you some optionality on the upside as well.
And so given that advice, gold, value stocks, bonds, does your advice change at all for speaking to a client who is in our age group, maybe you're Gen Xers, or someone who may be in like a baby boomer generation? Does that change at all? I would think.
It changes around. And one thing I didn't touch on is a lot of the private investing where we are seeing opportunities. And I'll talk about that here as well, where I think, again, this comes down to the planning where, some of the partners that we invest with, they actually buy real estate assets, or they make private loans to companies where they're securing their inventory, machinery, and equipment. And so there, I think, to the extent that we can embrace more illiquidity risk and earn a premium, right? You need to be paid more. Other things being equal, if I have two investments and they're identical, generally speaking, but one's publicly traded, one's private, the one that's privately held, because I can't convert it to cash, I should earn a higher return on, right? I think it makes intuitive sense. I think illiquidity, generally speaking, for younger investors, right? If we're working, right? If we don't really need access to the cash, assuming we have a nice cash reserve, we're not actually drawing down on the portfolio, we're sort of in accumulation phase, you probably can take on some more illiquidity risk, right? So, maybe we can have more of the real estate partnerships, the private equity oriented type partnerships, so we might invest in more of these sort of asset-backed loans as well, maybe a higher percentage. But we're still, even for our wealthier clients or retire, we're still going to have some of those in their portfolio. The question is how much, right? Maybe they're taking required distributions from their retirement accounts, or they need more cash flow from the portfolio just to sustain their lifestyle because they're not working.
It makes sense. And actually, one point I'd like to kind of come back to, you mentioned it yourself, and because we live in an age of information, and chances are, if our audience listens to podcasts, they're savvy on the internet. And you mentioned trying to differentiate information versus advice or actionable items. I imagine you see that all the time with your clients saying, I Googled this, I read Yahoo Finance that,
Yeah.
or my best friend just made $1 million doing this thing over here. I mean, geez, that has to be something that you have to address with clients all the time. And I'm just trying to wrap my head around this. What advice do you have for people out there that allows them to recognize, hey, this is a data point, but this doesn't mean you need to change the whole plan?
Yeah,
because I imagine that happens.
Yeah, I'll give you a classic example, right? I mean, we were not big investors in crypto. For better or worse. But I think this is a classic example around like, hey, should we make an investment in crypto? And I will tell clients, okay, let's pause and reflect on your question. Is this, and just because you make money in something or possibly can make money in something, does that actually constitute an investment? I'll give you an example. I can go to Vegas, I can bet on black, and I can make money. Now that's gambling, right? It's based on chance. Now,
right.
And so in many ways, it's reframing their mind around the context. And again, because I think people conflate different things around investing and what it really is. And so I don't have a problem with you, right, taking a certain amount, small amount of money and gambling. And if you make a few bucks on it, great, I'm happy for you, right? But let's make sure we understand that. Let's make sure we also calibrate the size of it, and also that it really is this sort of small piece, and that it is within the confines of your investment plan. We've already kind of predetermined that you have a certain portion that's allocated for high risk gambling type, situations, right? And that you're willing to lose all of it, and that's fine. But let's not mix that up with something that we can actually handicap what the upside return is and what the downside risk is associated with it, that we can wrap our arms around and understand what that risk is, and that the return potential on the upside actually justifies taking on that risk, and what role it actually plays in the execution of your life plan that we had, right? Just because I can make more on it, right? Is that really an investment? So,
well, and I would guess
clear.
No, it makes sense, and I would guess more often than not, especially maybe not in 2022, but maybe in 2021, people weren't actually going through that, risk analysis of if I put $10,000 into you pick a digital currency, then what's my possible reward? What's my downside? It was probably more, I don't want to miss out. What's the term?
It's FOMO. You're exactly right. It was fear of missing out. Yeah. It's, classic tulip bulb craze. And that has now, totally reversed itself.
Yeah.
And so again, it's that whole thing of like, as it's like, as being an advisor, you're, when you're trying to anchor or manage expectations, right? when they're thinking, hey, the world's flying high, you're trying to bring them down a little bit. And then when things are like, oh my gosh, doom and gloom, the world's coming to an end, it's like, hey, no, look, this is rough, but we can navigate through this.
Yeah. Well, I guess it's an interesting and funny way to think about this. If you think about investing in these more exotic items, you plan for what bad thing can happen. But when you don't analyze the risk and you just put $20,000 in and then you lose it all, then all of a sudden this is, panic, stress. Oh my God, I just lost. Where if you actually planned it out ahead of time, you analyze the upside downside, you go, okay, I took a shot, it didn't work.
Well, and it's funny, you're 100% right. I mean, when I ask clients the question, okay, are you going to be comfortable if you put 10,000, 20,000 in this investment and it's gone? How does that make you feel? Are you going to be okay with that? And more often than not, probably 8 out of 10 times, they're like, nah, you know what, I'll pass.
That's funny. Yeah.
Yeah.
You just need a sounding board for someone to say, are you sure? Because if you're comfortable going to zero, then let's give it a shot.
Yeah.
So are there any of those types of, I hate to call them investments, but just call them assets, whether that is Bitcoin, Ether, Tether, NFTs, or even what I think, and I'm learning more about is, investing in the metaverse. Hey, I can buy a house. It's not real, but on screen it's real. Is there anything there that, kind of tickles your fancy and you go, that could be something?
I probably sound like an old fuddy-duddy, and the short answer is, for us, we're risk managers first. I mean, I think there are perhaps others who candidly are more well versed in this space that maybe can know how to make money. And again, not that some of these, like, I go back to like the internet, right? And remember, and I recall like what it was like when everyone knew the underlying, the internet itself was going to change how we lived, right? In the late 90s. But then you had companies like pets.com that the valuation was through the roof. And yet people mix the two of those things up, right? Mm-hmm. The underlying technology with sort of these companies that were going to take over the world. And most of them, obviously we had the NASDAQ crash 80%, 90%, whatever it was. And it took, a decade or so to get back to the prior high. So look, I think the underlying, theory around the decentralized ledgers and whatnot that make up crypto and some of this, and separately the metaverse, like there probably are some really interesting practical applications. I think we know that. But that, again, doesn't make for necessarily a good investment. And history is littered with these kind of examples, for everything from like, the gold miners, right, to back in the, the 1800s to, the technology companies, and now these sort of phantom universe things. So I think for us, it's just an area that we haven't figured out how to translate into fundamental risk management and fundamental sort of investment valuation.
So what you're saying,
I would say we're much better, at looking at, can we make a loan that we're going to get our money back and get a very juicy yield on, right? Mm-hmm. Where there's in an area that not a lot of other people are playing in, mm-hmm. where we're senior in the capital structure, and sort of either way, if things go bad, there's assets to protect us, and if things go well, we get paid off and make a nice return. Or owning real estate, or owning businesses that we understand.
I mean, it almost sounds like, making the mistake of buying the car that looks shiny and nice, but the motor is 20 years old. Don't buy into the metaverse just because the technology sounds cool. Wait for something to actually come of it that you can see as a long-term valuable asset that could be great for your portfolio. Don't get wooed because it's a shiny red car. Wait for something meaningful to come out of it.
Yeah, I think that's 100% right. I think it's a great analogy.
Okay. Yeah. It's funny. To me, the metaverse, that's the one thing I see that go, okay, this could be something. I just don't know what yet.
Yeah, no, look, I think I don't disagree with you, right? I don't disagree with you. And I think, look, if someone's going to if they feel that way, right? And again, they're going to take look at it as you're making a bet on mm-hmm. something that is untested, that is unproven yet. Not to say that you can't make money. You very well could, right? Mm-hmm. But do it in a way that you're just not gonna wake up in 5, 10 years from now, a year from now, And if it's worth zero, that you're like, it really screwed up my financial plan, my life,
Yeah. Yeah. And just to share, when talking about all this trendy stuff with the young folks, if you call yourself an old fuddy-duddy, you're automatically sounding like an
Is that
old
right? I know,
fuddy-duddy.
right? Even at 46.
Just so you know,
I'm
that
only
automatically
joking,
makes you an old fuddy-duddy.
right?
So, hey, so as we start to wrap things up, I just want to ask, do you have just one piece of advice that you would share with our audience this year? Just, broad strokes. What's the one thing that's just saying, hey, keep this in mind this year?
Yeah, I think, look, is if you haven't started investing, start slow, but start. The old adage that people underestimate, they overestimate what they can do in a year, and they underestimate what they can do in 10 years. And I think that applies to their careers. I think that applies to investing. So I'm always a believer of like, just start small, be consistent, just get in the habit, build the good habits, and you'll be glad that you did 5 years from now, 10 years from now, right? That's probably, the single biggest thing would be one. The other is that however you feel right now in the moment, that is going to change. So, as people are building their financial plan and building their investment strategy, that's one of the reasons why the planning piece of it helps to counterbalance the investment strategy. If the investment strategy is left untethered to something other than itself, what I find is most people's emotions dictate the strategy du jour. And a lot of that's predicated on market conditions that are relatively transient. Mm-hmm. Right. And so all of a sudden they find themselves, what's the next shiny object? What's the next shiny investment? And they get in this sort of hamster wheel thing, right? Versus saying, hey, look, I've got a portion that's allocated to stocks. Like when I think of like stock allocation, to me, that's an investment that's for at least 10 years, right? The old Warren Buffett adage around like, you've got to hold it for the long term and don't think about owning it for 10 minutes if you're not going to hold it for 10 years. That's true. That really needs to be the mindset. And one of the biggest things is I think people think because stocks trade daily, they fall into this, and it's one of the biggest risks, that it's a liquid investment. And while it's liquid, it's liquid right now. We don't know if that liquidity will be there tomorrow. And should it really be liquid within relative to my own financial plan, right? Mm-hmm. So a certain amount for stocks, right? I've got a cash reserve. I've got more conservative investments. And then to the extent where our clients come in and where we do the planning is, can we bring in other investments beyond stocks and bonds, right? So that you've got 3, 4, 5, 6, 7 different asset classes, because you saw like last year where the traditional markets, both stocks and bonds, which were highly correlated, didn't provide that traditional diversification you usually got. Mm-hmm.
So, yeah. Well, you're obviously an expert in the field. Really appreciate all the advice. And just to flip it around real quick, can you tell the listeners something a little about you personally? What's on the backside of the card? Yeah, what do you do in your free time?
Sure. Well, I'm married, got a couple of kids. These days I love working out. I used to do a lot of Krav Maga. I played collegiate football. But more recently, the last couple of years, I've gotten into Brazilian Jiu-Jitsu. So I drank the Kool-Aid, and I'm doing that. I also do guitar. So been working on my soloing and learning different scales. And Jen and I love to travel as well. So those are some of the things I like to do when I'm not busy being an advisor to my clients.
And do you have an exciting new travel or a destination coming in the near future?
We're trying to think of one. We're amidst a house remodel that's kind of sort of taking up all the headspace. My hope is with inflationary pressures coming down, the supply chain issues kind of easing, that we'll get through that here. But I think by this summer we'll kick back up to we went to Alaska in 2019. That was an epic trip. We went to China in 2017, so we're due for kind of a cool trip. So hopefully by the end of 2023. I mean, I think I did a pretty cool dirt dual sport trip last year from from Sequoia to Yosemite, and I'm not a very seasoned biker motorcyclist, but it was a phenomenal trip. So more trips like that, and hopefully you and I can go out on one.
Oh, I look forward to it. Well, Joe, thank you again so much. So if our listeners wanted to reach out to you, connect with you, maybe talk to you about their investments, how can they find you?
Absolutely. They can hit me up on LinkedIn, right? So Joe Seetoo, or feel free to shoot me an email, jc2@mortonwealth.com. Or if, they love picking up the phone, they can give me a call at 818-591-6219. I'd love to talk to them.
All right, Joe, thanks so much for being a guest today. Really appreciate it.
Thanks, Chris. Great seeing you.